Hello, I'm Tim Beggans, president of Elk Trading Company. In today's video, we're going to review a Goldman Sachs video on the European crisis for natural gas and implications for the US. I have some thoughts.
Conflict, there's an equally unsettling story unfolding in the natural gas markets. I'm Allison Nathan, and this is Goldman Sachs Exchanges. For today's episode, I'm sitting down with Samantha Dart, co-head of Global Commodities Research, to talk about the implications of a natural gas shock, which may, in some cases, actually be more damaging than an oil shock. Sam, welcome back to Exchanges.
Thanks for having me.
So, we have talked a lot on this podcast about the impact that the war in Iran is having on oil markets. But today, I want to dig into the implications for natural gas markets and liquefied natural gas, which is commonly referred to as LNG, because I think it's actually an area that a lot of our listeners sort of underappreciate in terms of this conflict and in terms of its importance in the economy. So let's just start at a high level. First, give us the basic, what makes natural gas markets fundamentally different in how they respond to geopolitical shocks?
And here, natural gas is going to be explained, just giving the introduction of the three main uses for natural gas, in particular in the Northern Hemisphere.
Yeah, I think the main difference is the seasonality of demand, the fact that you need so much of it in the winter. And maybe we should take a step back and think, what do we use this thing for? And there are three main uses. The first one you can think of is electricity generation. Just you have a lot of utilities they have, in the same way they have nuclear plants and coal plants, they have natural gas run power plants. You also have a lot of use of natural gas for industrial applications. You can either use that directly as a feedstock into whatever you're producing, or what is most common is to just use to generate heat and energy for the manufacturing processes. And the thing that is used for the most is really heating in the winter. So the whole Northern Hemisphere really focuses on having enough natural gas just ahead of winter. And this creates a little bit of a predictable price dynamic.
So what Samantha is referring to, especially on the industrial processes, is that U.S. and industries along the Gulf Coast in particular use natural gas either as a feedstock to create other things or to bring it into a power plant to create both power and steam. This is particularly important for U.S. refineries in the crude oil system.
Tied to storage dynamic. These markets, they use so much of it for heating from, say, November through March, that's where they are drawing inventories down. And from April through October, it's like the opportunity time to rebuild those inventories. So the way that prices move, usually they move exactly to help the market build inventories in the summer, that April to October period, so that you have enough in the winter. So you have a shock like this, a supply shock today, and we're not in winter anymore, but we have that looming in the horizon. It's almost like a deadline. Okay, you have 7 months to fix this, and not just fix the disruption you have today. Whatever impact that has had on inventories today, we have to offset it completely by the end of October.
So that is correct. But in the US, natural gas storage stocks are doing very well. Currently, we're over 6%, 6.5% over the 5-year average. We're only slightly below last year, but inventories remain healthy. Production is running about 113 BCF a day, where LNG feed gas is currently only 18 BCF a day. So natural gas production remains stout in the US. The problem remains Europe. Why? Because Europe is dependent upon Qatar. Qatar exports a lot of LNG and brings it to places like Asia and then Europe as well. Europe inventories are sitting anywhere from 10 to 20% below where they were last year, and their target is only to 80% full. With current inventories near 60%, they're running out of time, which means that US LNG has to fill in the gap for the lost Qatari cargoes. It cannot fully compensate, and that's where the energy crunch is coming in.
So it's that tight deadline that can keep things very, very tight and can make this process somewhat painful, because if you don't have supply and you don't have spare capacity in the system, which you usually don't for natural gas, then prices have to go up and up and up to destroy demand and make this work.
Right. So both industry, if I'm hearing you correctly, and households are very exposed to these natural gas disruptions, and the seasonality plays a big part in this.
So not for the US. US looking at an El Nino forming here, a very super El Nino, possibly a record, which means warmer temperatures in the northern tier. The southern tier is going to be wetter and cooler, which means it will have overall an expected mild winter. Europe, not so much. Polar vortex disruptions have occurred during El Nino years, the last December 2023. So this is more acute in Europe rather than the United States.
If we think about what's happening in the war right now and the escalation we have seen, there's been attacks, well-reported attacks on Qatari LNG infrastructure, liquefied natural gas infrastructure. So that's put at risk 20% of global LNG supplies. Just give us an update on where we are in terms of the supply picture right now amid this conflict.
Yeah, when we look at 2025 data, Qatar produces the equivalent of just about 20% of global LNG supplies, and all of that is disrupted at the moment. It's all shut down, their capacity is shut down, and we had the bombings of infrastructure a couple of weeks ago that has caused long-term damage to some of that infrastructure.
And that is correct. The Iranian drones and ballistic missile attacks on Qatari facilities damaged two trains, trains 4 and train 6. That was the south part of the field, and that is going to be disrupted for 3 to 5 years. Hopefully, it will be sooner than that. But more importantly, the Strait of Hormuz is effectively closed. There is some transit going on with ships taking off their transponders and trying to make the passage, but the passage remains dangerous, and LNG facilities, and in particular Ras Laffan, are running just enough to keep things effectively open, but according to the ships, there's only coming in for a few days, loading up potentially small cargoes, and making, say, transit trips up to Kuwait, which needs LNG, but really not transiting the Strait of Hormuz. That effectively remains closed indefinitely.
So even when the flows through the Strait of Hormuz are restored, Qatari supply is not going to fully come back to normal for many years.
So if we think about how the market has actually responded to these massive disruptions, give us the lay of the land. And is there anything surprising about how the market has reacted?
Yeah, to be honest, I would have expected prices to have rallied more than they have. Prices have gone up, don't get me wrong. They've gone up, over 50% already. I'd say between 50 and 70%, depending on the day. But that's only enough to make natural gas more expensive than coal. And that does help. If you're making natural gas more expensive than coal, you're creating the incentive for utilities. Okay, just burn more coal and leave the gas alone for storage for the winter. But for a shock of this magnitude, I would have expected more. I would have expected that natural gas would maybe become more expensive than some oil products like propane or fuel oil to incentivize additional switching, or also to incentivize additional industrial shutdowns in Asia. Asia used to receive most of the Qatari LNG, so the higher natural gas prices are, the lower the operation rates at a lot of Asian industrial sites.
And that is correct. Only recently have LNG prices, the global LNG prices, moved higher, such as TTF and JKM. And we're going to start seeing some of that industrial disruption coming in Southeast Asia in particular. Why? Because the Strait of Hormuz remains closed. Qatari volumes are locked in, and they have no means of export at this time. But US LNG is trying to ramp up and trying to get ahead of winter. It cannot fully replace Qatari volumes, but it also is giving a green light to North American LNG projects, both in the US and Canada. So this disruption has been expected to hurt European and Asian industries. And right now we're starting to see the reaction in prices. But let's see what happens here. Europe has been betting on a warm winter. Let's see if the Strait of Hormuz can be reopened anytime soon.
And we're not seeing that. I mean, we're seeing some demand destruction, but prices are just above coal and nothing else.
Right. Let me just interject for a second because it is an interesting dynamic, this substituting dynamic. Maybe just give us 30 seconds on what that looks like when you talk about all this substitution and the role that that really plays in this market.
Yeah, a lot of times it's really about what incentive you're giving to utilities, for example. I can generate power with natural gas in my plant, and I have, let's say, a neighbor that runs a coal-fired power plant. And usually, if coal is more expensive than gas, which happens in Europe in particular, where you have carbon pricing, then you're not really using a lot of coal and you're using a lot of natural gas. The moment natural gas gets super expensive, I look at that, and even if I'm not the one running the coal plant, I have the incentive to just shut my plant down and buy the electricity from those guys burning coal because that's cheaper.
Right.
And in Europe, unfortunately, they've taken nuclear power plants down permanently, like Germany. And there have been problems with knocking off coal, especially in places like the UK and Germany again. Really, right now, Europe has been betting on the Strait of Hormuz to reopen. It's also been betting on a warm winter, an El Nino type winter. It's also been dependent upon strong Norwegian natural gas flows. It's really becoming quite thin.
So yes, there's a lot of flexibility in how you generate power, which again, I think is a little bit underappreciated. So you mentioned that there's actually been some long-term damage to some of the supply infrastructure. So, talk to us about what it's going to take to get back to where we were before the war.
After the bombings, Qatar came out and said, oh, it's going to take us 3 to 5 years to restore capacity to 100%. When they say 3 to 5 years, I mean, it doesn't take 3 years to fix anything. What they're really saying is these two liquefaction trains were so damaged that we need to start over. We need to rebuild them from scratch. So this is the risk that you run, that you can have infrastructure that is just completely flattened and you just need to rebuild it. And this does take years.
So the Qatari facilities are damaged, but the supply chain for LNG facilities globally is thin. And that's the problem. These are specialized equipment at these very remote locations, such as Qatar. So the supply chain is just not sitting on inventory. The inventory must be created. And in particular, these facilities were damaged. The question is, how extensive were they damaged? Right now, Qatar is heavily incentivized to fix this and therefore pay the price to find the parts or create them as fast as possible. The bigger problem is the transit through the Strait of Hormuz. So now Qatar has to think about, how can I get around the Strait of Hormuz constraint? Do I need to create a pipeline that moves volume somewhere else and then liquefy them for transit? Say a pipeline to the Mediterranean. Maybe a pipeline somewhere else, perhaps outside of the strait, like Oman. So these are the things they'll be talking to their neighbors over the next few years to figure out how to get out from this problem.
Even if there isn't that much long-term damage in some of this capacity, what will it take to actually get it back online?
Yeah, there are a few issues to think about. The first one is when we think about the production site itself. It's very large. It was fully shut down. That can be restarted. I think it would take no longer than 2 to 3 weeks. But you have, I think, two main challenges beyond that. The first one is that Qatar is a prolific exporter, so they have dozens of tankers that are just scattered at the moment, and you would have that logistical challenge of getting everybody in line, get everybody together to load new cargoes and send them out. So if you think in a matter of weeks, that can be solved too. But now the second challenge after the bombings that we saw is, do you have shrapnel that maybe damaged other infrastructure that we don't know about it yet? So at this point, I imagine they will have to review the state of infrastructure, and we don't know what they're going to find. So it can potentially lengthen this disruption.
So LNG facilities, just take a look at Golden Pass, take much longer than just a few weeks to ramp up. It's a process that is under pressure and highly flammable, so it has to be done very, very carefully. A few weeks is underestimating how long it will take to bring on all the equipment at Qatar. This means that we will be looking at months, not weeks, in order to bring in stable operations for full volumes. At this stage, the problem is the transit of the Strait of Hormuz. The equipment is going to be fixed, they'll have enough time, but it will take months to stabilize all these processes.
So, what are you expecting now in terms of thinking about supply losses going forward?
Yeah, so we talked about at the moment just about 20% of supply disrupted. If we assume that this gets resolved in the next few weeks, then for the remainder of the year, that gets moderated. And your overall, let's say, balance of the year damage to supply is not that large. We're talking maybe 5-6% of supply of liquefied natural gas. But that brings us back to the issue of duration. What if it's not solved in the next couple of weeks? What if this thing drags? And the longer it goes, the more damage you do to that task of rebuilding storage capacity. So that's why the potential for price increases is not done. We can see much more from here. I think one of the reasons why we haven't seen more right now, we talked about how surprising it was that prices hadn't gone up more, is you look at European balances today, they don't look that bad in terms of LNG inflows into the region. Qatar was sending most of it to Asia. Asia has been the main one hit so far. One big driver of that has been China. China had a mild winter, so they had plenty of storage, and they looked at those high prices and thought, maybe we ought to use our inventories a little bit more now that we're at the tail end of winter, we're not going to need it much, and sell those cargoes into a very high international market. So that's what they've done. And by doing that, they've allowed Europe to keep more LNG coming in.
And that is correct. China has not been a huge buyer of LNG on the spot markets, and that has helped Europe. But Europe is still running, again, anywhere from 10 to 20%, depending on the country, behind last year. And this can't last forever. China is leaning on coal and renewables to try and get through this crisis. But even China needs some LNG for specific industries, and therefore they're going to have to come into the marketplace. The Strait of Hormuz remains closed. This video was done a few months ago, and unfortunately, the conflict is not ended.
So prices are somewhat moderate, but the longer this goes, the amount of supply you're losing from Qatar every single day is still more than 4 times what China is saving the world right now.
Right. And there are other sources of supply too. So the U.S. is a very large LNG exporter. Can it make up for some of the shortfall?
You're right. The U.S. alone is responsible for just about 30% of global liquefied natural gas supply today. The problem is there is no spare capacity. What you see is what you get. So you can have international prices rally, rally, rally. And I'm sure the US LNG exporters would love to sell more into that attractive market, but they don't have the capacity to. And again, this is capacity that takes such a long time to be built. You can't fix that overnight. So you end up with a situation where the US, the largest producer of LNG in the world, is just sitting there and can't help the rest of the world rebalance the market.
And that is correct. But US LNG facilities appear to be taking time this summer to do the most maintenance they can. Why? Because they anticipate that the spread between US natural gas prices and global gas prices will be even wider in this winter, which means that they are highly incentivized to make as much LNG as possible this winter. The cooler the temperatures, the more LNG they can make at these facilities. They are strained during hot, humid temperatures like we're seeing here in Texas right now. We're in triple digits, which means these plants can't get anywhere nameplate capacity. Those are the big box LNG facilities. The modular US LNG facilities are much more reactive, such as Plaquemines. That's doing very, very well, near or over nameplate capacity. But places like Golden Pass, parts of Sabine Pass, Cameron LNG, parts of Corpus Christi just simply can't produce as much LNG as possible during hot and humid temperatures. So, US LNG facilities are gearing up for winter. They will be producing as much as they can to fill in the gap for Qatari volumes.
So the US doesn't have excess capacity. Asia has been selling into the market, but that can't go on forever, as you just said. So what does this all mean for Europe? It's very fresh in everyone's minds, the 2022 experience where Europe was really scrambling in the wake of the Russia invasion of Ukraine and, the impact on natural gas markets then. Is it likely to see a similar scenario, or how concerned are you about such a scenario playing out this year?
It's a good question. We like to think that there is no imbalance that you can see this many months in advance that can't be solved. But to me, it does come down to the duration of this disruption, because right now we have China with low demand. We have this potential ceasefire deal that we may get. If the situation is resolved, then we have no problem for Europe for the winter. But if this thing drags longer, it will require more demand destruction to fix inventories before we get to next winter. So there is a risk that this just drags so much that it makes the process very painful, meaning very high prices to destroy a lot of demand. So it's really duration dependent here.
And that is correct. And it has been continuing to have a conflict here between Iran and the United States. But who benefits from this? Well, US does. Why? Because they have plenty of US natural gas to export during winter, and the facilities will be up and running. What else happens? European countries have to think about pushing for investment in the US. Chemical facilities in particular are thinking now, hey, I've got a problem. I may not be able to get any natural gas. The Qatar is shut. Russian LNG and Russian pipeline gas is no longer available, and the US is constrained. Where do you go? You go to the lowest cost feedstock producer, the United States and maybe Canada. So we'll be looking at how much investment European countries will be making here in North America as this conflict continues to erode.
And so, best case scenario, worst case scenario, what are your expectations in terms of the distribution of outcomes?
Absolutely. So if this disruption gets resolved imminently, all that natural gas prices need to do is just to continue to price above coal for the remainder of summer. What this means is maybe about 20% below where they are today. So that's good news for Europe. It's good news for the rest of the world. But if the conflict drags and really overwhelms this saving of demand that China is showing the rest of the world, then that might not be enough. And then what we think we might see is 50 to 100% of upside to prices from current levels, because we would need to get to a different stage where markets need to incentivize more demand destruction. And this is how much it might cost. So the scenarios, they are so binary here. Things can look really affordable pretty soon, or we might have to just test new highs. And like I said, up to 100% higher than we are today, just to make sure we have enough natural gas for next winter.
And Europe is going to be pinched. If Norwegian volumes drop off, Europe has got to make some very, very hard decisions, such as cutting the price of carbon in order to allow industries to survive very high natural gas prices. That's right, they've got to make some really ugly choices. If Norway volumes are disrupted at all this winter, they're going to be very, very pinched. What are you going to do? I think they're going to be really out there buying as many spot cargoes from the globe, in particular from the US, as September and October kick in. That means that natural gas prices globally are going to go higher, and that may pull up US natural gas prices with it. But in general, the US is very well supplied. The rest of the world, not so.
And there's a lot of mixed signals about the conflict right now. And what I'm hearing from you is that's complicating this process a bit because it is letting the market avoid higher price spikes today because of the uncertainty, but they may come into the market later if need be.
Yeah, it's so interesting. It's almost like that story of the frog in hot water, that it's just, I heard that's a myth, but it still works as a metaphor. If the water is heating up, heating up, heating up, and the frog is not jumping out, it's gonna die. So we are in the situation where the headlines are back and forth, back and forth. Is this thing gonna end? Maybe not. Maybe it is. Maybe not. And prices are not giving us enough incentive to destroy demand and guarantee the storage situation today. So we're not.
Right.
We're not doing that. Is it going to be too close to winter to get it done when the time comes? And I think that's the real risk.
So the problem with European injections in particular is that the front to back spreads, the storage injection spreads, are not there. But that means that the decision still has to be made. And it will be made sometime in late September or early October when inventories need to increase regardless of price. And that is when you may see prices really ramp up because Europe cannot reach 80% full at this stage unless winter is much delayed and warmer overall. If it gets a polar vortex disruption like it did in 2023, they are in some serious trouble.
Fascinating, Sam. Thank you so much for joining us.
Thanks for having me.
This episode of Goldman Sachs Exchanges was recorded on Monday, April 6, 2026. And as always, keep up with the latest market moves and opportunities with our weekly companion podcast, The Markets.
So we'll hit the like and subscribe button here because this has been a fantastic video from Goldman Sachs. We welcome all comments on the energy market because they are so dynamic. And this winter is going to be one for the history books. Let us know your thoughts in the comments section below. Please hit that like and subscribe button. Thanks for listening. We'll see you soon.